How to Invest in Emerging Industries and the Dangers Involved. By StockCryptoBonus.com. Putting money into a new industry can be one of the best ways to make money. It can be one of the most dangerous, though. During the dot-com boom, when it seemed like any company with .com in its name could go public and raise a lot of money, many people got rich. It's not surprising that this boom of excess was followed by a huge bust. Today, the public is interested in many other new industries, such as big data, cryptocurrency, digital payments, and more. Even though none of them may be as groundbreaking as the internet, they all have the potential to make a lot of money. But investors should be careful to separate the hype from a new industry's real potential. Be careful of the hype cycle. Investors in new industries should know what the hype cycle is and how it works before they put too much money into an industry. The hype cycle shows how a new industry becomes part of everyday life. As the industry grows, more people start to use and value the product. Stocks go up. As it becomes more of a trend, the media, Wall Street, and evangelists all start to talk about it. At this point, all the talk is about how the industry will change everything. Here is where stock prices tend to peak. The industry may change the world, but not in the time frame that stock prices suggest. So, stocks plummet. Many companies go out of business, and the news goes from hyping things up to talking about how bad things are. A few years later, the companies that survived the first wave are still around and making money. They are also starting to live up to some of the early hopes for the industry. The hype cycle happens over and over in new industries, and it's a good way to understand how hype affects stock prices. If you want to invest for the long term and not just trade for the short term, you should think about where the cycle is when you decide to invest. Don't let the hype get to you. Consider the long-term view of the industry. If you want to invest in the emerging industry, you should look at how these companies will do in the long run, not just how their stocks are doing in the next few months. This is a huge difference between the stock and the company itself. Even though the stock may be going up fast right now, the success of the business is what will drive it up in the long run. This is why evaluating the industry is so important. Will the industry's effects be huge, like the internet? Is there a way to make money in the industry? For example, people who want to invest in the ride-sharing industry have to figure out if it can ever make money. People who want to invest in electric vehicle companies have to figure out how more competition will affect the industry. Remember, you don't need to buy now. When an industry is doing well, investors and the media pay a lot of attention to it, and it's easy to get caught up in the excitement. But if a business is going to be around for a long time, you don't have to be the first one in line to make a lot of money. The rise and fall of the internet in the late 1990s is a great example of this. Even back then, it was clear that the internet was here to stay, but stocks were so expensive that many smart investors stayed away from them. A few years later, the worst companies had gone out of business, leaving the remaining ones with less competition and much lower prices. You don't have to be the first in a new industry to be successful, even though the media, your friends, and your family will try to convince you otherwise. Do adequate research. Even though it might seem fun to treat investing like gambling, this is one of the most surefire ways to lose money. Investing takes work, and you need to know something about what you're putting your money into, especially if you're buying individual stocks, which are seen by many as one of the riskiest ways to invest. When you do research, you should think about how the business will make money and a lot of other things. Which companies are in the best place? Where is the industry going, and what technologies are they working on? What gives companies the most trouble, and how can they fix it? Is now a good time to invest, or do the business world and the press still have more hopes than facts? These are just a few of the questions you'll need to answer before you start investing in an emerging industry. Consider buying an industry ETF or a basket of individual stocks. If you like an industry but can't figure out which company is most likely to do well, one option is to buy an ETF that is made up of stocks in that industry. The fund gives you access to the most important companies in the sector. It also spreads out your risk so that you aren't too dependent on just one or two companies. But if the industry is really young, there might not be an ETF yet. In that case, it might make sense to put together your own group of stocks from the same industry. First, figure out how much of your portfolio you want to put into this business. For example, 5% is a good number because it gives you a lot to gain if you're right but won't ruin you if the industry doesn't do well. Second, divide your money among the 5 or 7 companies that are in the best position. For instance, if you have a 5% allocation and choose 5 companies, each gets 1% of your total capital. Allocate a small percentage to this investment. When you put your money into a new industry, the future is often very hard to predict. This is not the time to be brave and take a lot of risks because you think that's the only way to get big success. That's why you should only put a small amount of money into risky companies. If you buy individual stocks, don't put more than 1 to 2% of your portfolio into any one position. If you're buying a fund or a group of stocks, you could invest more, say 5% of your portfolio. In the end, you have to be able to handle losing all of your money, so don't invest more than you can afford to lose. Don't forget the larger companies. Many investors try to find a small company that is doing the next big thing, hoping to get in on the ground floor, or close enough, so that the company can go much higher. It's not a bad plan, but there's a less obvious one that might work better. Find a big, well-known company that is investing in the industry. Small companies are often seen as places where new ideas are born, but large companies have the money to make the large investments that are often needed. Plus, they might find it easier to get the managers and workers they need to make the project work. For example, Alphabet, the company that runs Google, is one of the best positioned companies when it comes to self-driving cars. Alphabet's self-driving project is called Waymo, and it has been able to hire the right people because the larger company has a lot of money and a culture of innovation. Bottom line: if you want to buy into a new industry, you'll have plenty of time to do so and still make a lot of money. The first step is to look at the market and figure out how it could grow. When you buy stock in a company, you might want to buy small amounts of stock on a regular basis because stocks in the industry tend to be volatile and go up and down a lot. By averaging the prices you pay over time, you'll be less likely to pay too much. You'll also want to keep your trading costs as low as possible. A great way to do this is to use a commission-free online broker like Charles Schwab or Robinhood. Disclaimer: all investors are advised to conduct their own independent research into investment strategies before making an investment decision. This video originally appeared as an article found at StockCryptoBonus.com. Read more articles like it and get more information, tips and advice about the stock and cryptocurrency markets at StockCryptoBonus.com. Remember that the price of investments may vary depending on changing market conditions. Don't forget to subscribe and click on the bell icon to get notification to get our latest videos on big investing and financial topics of the day.